Welcome, dear traders. After economic headwinds in the first half of the year, investors are still looking for signs of a recession. Macro stats increase market uncertainty as they reflect the most vulnerable sectors of the American economy. The topic of the recession causes many debates. Analysts have not come to an undivided opinion yet. Some of them believe that the economic downturn in the United States, which will eventually adversely affect the global market, is around the corner. There are those who say that recession has already occurred. Others do not expect a recession, at least this year, as the labor market remains strong. And this week, speculators are anticipating the non-farm payrolls report. Wall Street closed higher on Friday amid hopes that the Fed would slow the pace of monetary tightening. Investors in the Asian stock markets remain cautious at the beginning of the new week. The stock indexes were trading mixed in the Asian session. This week, traders are looking forward to the U.S. labor market data and the FOMC meeting minutes. These market events will be in the spotlight. Apart from that, speculators are also expecting the release of China's Services PMI Index and the Reserve Bank of Australia decision on the interest rate. On the first trading day of the third quarter, stocks were able to advance despite some negative economic reports. Yet they closed last week in the red. The Manufacturing PMI Index in June remained near two-year lows. The reading fell more than anticipated. Apart from that, the U.S. revealed weaker than expected reports the day before, namely the Consumer Confidence Index and weak GDP figures. Concerns about the possibility of a recession are weighing on market sentiment. The monetary policy tightening by leading central banks may restrain galloping inflation but slow down economic growth. Any positive news could trigger another short-term rally. Stocks will be unable to begin a steady recovery until inflation starts declining. The ISM PMI Index for June has proved once again that the U.S. economy is rapidly losing steam. Will this factor impact the US dollar? It's unlikely. It's not wise to trade the greenback, focusing only on the expansion of the US economy. The US dollar index climbed above 105 points, approaching the highest level since December 2002. Demand remains firm thanks to the Fed's hawkish stance and the growing risks of a global recession. Given such a market situation, the US dollar may grow even higher as a safe haven asset. The same can be said about the yen. The US dollar also jumped against risk-sensitive currencies such as the Australian dollar. The index gained more than 1% last week after reaching new highs in the second quarter. In today's Asian trading, the US currency maintained its bullish bias. In the case of further rise, the greenback may reach an early high of 105.80, looked after the June FOMC meeting. If this scenario comes true, it may try to break above 107.30, a high of December 2002. The recent decline in the dollar-yen pair came as an unpleasant surprise for those traders who expected the price to hit 137.50. Their predictions did not come true. Demand for safe haven assets increased amid the high risk of recession. The yen managed to assert strength amid the risk of sentiment. What to expect next? In order to regain momentum, the US dollar should consolidate above 136.45 in the coming sessions. Otherwise, it may go below the current levels. At the same time, a breakout of 135.50 has already taken place. Downward pressure on the USD JPY pair may increase if the US dollar dips below the 134 level. Traders will closely monitor the movements of the pair near this level. The yen is the weakest among their main currencies this year. Now the price seems to have halted its fall. However, the likelihood of a further drop remains high. Analysts contemplate the US dollar is unlikely to rise above 140. 40. After that, traders should expect a sharp reversal. The Australian dollar lost almost 9% against the US dollar in the second quarter. It's also weak ahead of the Reserve Bank of Australia meeting. The situation is unlikely to change even if the regulator hikes the interest rate this week. Market participants are betting on a 50 basis point rate hike. If this assumption is correct, market reaction is likely to be rather muted. An increase in key rates cannot offset a strong decline caused by a sell-off in the global stock market. The Aussie may also decrease if the Reserve Bank of Australia raises the cash rate less aggressively. Some analysts believe that the rate hike may total 25 basis points. The Australian dollar could recover only if the Reserve Bank of Australia provides some positive statements about the economy and the talks of a recession in the US continue. However, even in this case, there are some buts. Its further decline looks more likely now. However, in the Asian session on Monday, the AUD-USD pair showed signs of growth. In the short term, if stocks and metal prices are in the red, the pair may slide below the 0.6800 level. Analysts note that its recovery may start in September. In autumn, the AUD-USD pair could finally rise to 0.7000 and then to 0.7200. A more aggressive monetary tightening by the Reserve Bank of Australia may also boost the Aussie by the end of this year and the beginning of the next one. This will happen if market sentiment improves. The pair is expected to jump considerably in the fourth quarter when the US dollar begins to lose ground. And now traders are looking for clues about whether inflation has peaked. Any signs of it may signal of a more favorable state of the US economy. However, given the situation in the markets, analysts do not count on a sustainable recovery. And that's all for now. Subscribe to InstaForex TV channel and keep close tabs on market developments. See you soon.